Imagine standing atop a Payoh pinnacle, watching the sunset over an island of concrete dreams. For years, the narrative was simple. HDB prices only go up. But as we step into the first quarter of 2026, the golden era of effortless appreciation has hit a brutal wall. While headlines scream about record-breaking million-dollar transactions in Yishun and Dawson, a silent, chilling reality is unfolding beneath the surface. For the first time in years, the broader market has ticked downward by 0.1%. This isn't just a statistical glitch. It is the first crack in the dam. Today, we peel back.
Let's look at the cold, hard numbers that the property agents aren't posting on TikTok. The Q1 2026 resale price index has officially registered a negative growth of 0.1%. While that number seems microscopic, its significance is tectonic. It represents the psychological breaking point where buyer resistance finally overcame the post-pandemic frenzy. We are seeing a digital heat map where traditional gold mines like Queenstown are cooling rapidly, turning from vibrant amber to a cautionary blue. The momentum has stalled. For every high-profile penthouse sale making the news, 10 suburban four-room flats are sitting on the portal. The million-dollar flat is the ultimate siren song, designed to lure you into a false sense of security. In Q1 2026, these transactions accounted for less than 2% of total volume, yet they occupy 90% of the media headspace. This is a classic survivorship bias trap. These outliers are fueled by a very specific, shrinking demographic, wealthy downgraders from private estates with deep pockets. For the average Singaporean couple, chasing these highs is a recipe for negative equity. You are paying a premium for a lease that is already decades deep into its 99-year life cycle. When the broader market dips, these overpriced trophies are often the first to see their liquidity evaporate instantly as buyers vanish.
What goes up must eventually meet the crushing weight of supply. Between 2023 and 2025, the Housing Development Board flooded the market with a massive injection of BTO units. Now, in 2026, we are witnessing the MOP tsunami. Thousands of new, modern units are hitting the resale market simultaneously, creating a buyer's paradise and a seller's nightmare. This sudden influx has effectively neutralized the scarcity value that previously propped up older resale prices. In estates like Tengah and Jurong West, the competition is fierce. Sellers who once held all the cards are now forced to undercut each other just to secure a viewing. The scarcity myth has been shattered by a massive wave of new keys and fresh beginnings. Beneath the steel and glass lies a demographic time bomb that is finally starting to tick. Singapore's aging population is entering a phase of massive right-sizing. As the silver generation moves out of oversized family flats into smaller, assisted living studio apartments, the market is seeing an unprecedented volume of large-format resale flats being listed. This silver tsunami is creating a structural oversupply in the 5-room and executive apartment segments. At the same time, younger couples are facing shrinking family sizes and a preference for location over square footage. This fundamental mismatch between what is being sold and what is being sought is pulling the floor out from under the high-valuation resale market across.
The era of cheap money is a distant memory, and the delayed impact is finally hitting the HDB heartlands. In 2026, many who took out floating-rate loans or are looking to refinance are facing a harsh reality. With mortgage rates stabilized at a higher plateau than the last decade, the total cost of home ownership has skyrocketed. $1 million flat isn't just $1 million. With current interest rates, the total repayment over 25 years is staggering. This has drastically reduced the maximum loan eligibility for the average household. As the borrowing power of the masses shrinks, the ceiling for resale prices must naturally lower. The math simply no longer supports the astronomical bids of the previous years when interest was nearly zero.
We cannot ignore the invisible hand of the government. The cumulative effect of multiple cooling measures, including the tightened loan-to-value limits and the increased wait-out period for private property owners, has finally choked the speculative heat. By Q1 2026, the friction in the system has reached a critical mass. These policy levers were designed to ensure housing remains affordable, and they are working exactly as intended. The plus and prime models have also redirected demand, anchoring expectations back to reality. The government has sent a clear signal. HDBs are for living, not for windfall profits. Investors who ignored this signal are now finding themselves trapped in assets with limited upside and increasing regulatory friction that prevents easy exit.
The old adage of location, location, location is being challenged by the reality of lease, lease, lease. In early 2026, the market is showing a sharp divergence. Older flats in prime areas, once considered bulletproof investments, are starting to show signs of lease decay fatigue. Buyers are becoming mathematically savvy, calculating the terminal value of an asset with only 50 years left. The fear of being the last buyer is real. This has led to a flight to quality, or rather, a flight to newer leases. Even in popular areas like Payoh, the price gap between a 40-year-old flat and a 10-year-old flat is widening, leaving owners of aging units with
Fear of missing out is a powerful drug, but its come down is painful. For the past 3 years, the fear of being priced out forever drove many to overextend their budgets, convinced that prices would never drop. This herd mentality created a bubble of artificial demand. However, psychology is shifting from fear of missing out to fear of overpaying. As the news of the 0.1% drop spreads, the collective confidence is wavering. Potential buyers are stepping back, deciding to wait for further declines. This change in sentiment creates a self-fulfilling prophecy. When the crowd stops running, the momentum disappears, and the true value of the asset is laid bare.
To understand the HDB trap, we must look at the narrowing gap between public and private housing. In Q1 2026, the price of a top-tier resale HDB is often uncomfortably close to an entry-level executive condominium or a fringe market private condo. Smart money is starting to ask, why pay $1 million for a restricted asset when you could own a private one for slightly more? This substitution effect is siphoning away the high-end HDB buyers. The prestige of $1 million HDB is losing its luster when compared to the amenities and capital gains potential of the private sector. This ceiling effect is preventing HDB prices from climbing any further, effectively boxing sellers into a very narrow and crowded price.
As we look ahead into the remainder of 2026, all indicators point to a sustained correction. The 0.1% dip in Q1 is likely the beginning of a multi-quarter trend. We are entering a phase of price discovery, where the market reevaluates what a flat is actually worth, without the distortion of a global pandemic or supply chain disruptions. Economic headwinds and a cautious labor market are making households more conservative with their long-term commitments. The tipping point has been reached because the fundamental drivers of the previous bull run have all reversed simultaneously. If you are holding an asset hoping for another 20% jump, you are likely looking.
The era of the $1 million lottery is closing. This is not a call for panic, but a call for prudence. Housing should be a home first and an investment second. The Q1 2026 data is a gift of clarity, warning us that the ceiling has been hit and the floor is shifting. If you are a buyer, patience is now your greatest asset. If you are a seller, realism is your only path to a transaction. The trap is set for those who ignore the data in favor of the hype. As the digital heat map turns from gold to red, remember that in the world of real estate, the trend is your friend until it isn't. Stay informed, stay cautious, and think long-term.